Now, as you know, on Good Up, we're not only all about some great music, we also like to have some very, very important discussions. And so it's time for us to get into a really cool chat, courtesy of the CISA Foundation. The Saver Wire Wire L Plus Earn Financial Education feature is brought to you by the CISA Foundation and funded by the Export Credit Insurance Corporation of South Africa. And I'm very excited tonight because today on the line we have Michael Maré. He's a certified financial planner and member of the professional body, the Financial Planning Institute of Southern Africa, to chat to us more about a topic that I think I only learnt about in my early 20s, and that topic is investing. Michael, welcome to Good Up FM.
Good evening, Danilo. Thank you for having me, and good evening to your listeners.
No, it's an absolute pleasure, and thank you so much for just giving up some of your time to impart of what's really important knowledge, I suppose, for young people. As I mentioned, I think I never really learned about investing until I was maybe in my late teens, early 20s, because it all just seemed way above me. And so I'm very excited to have the discussion today. But if you have any questions for Michael as well on investing, please do send them through on our WhatsApp number, 071 286 0639. We'll be taking all of those questions on air today. Right. I think, Mike, the first question I wanted to ask you is about the difference between saving and investing. Because, you know, in South Africa, everyone's always heard we don't have a savings culture. But then explain to us the difference between saving and then investing.
Absolutely, yes. So saving and investing are two very equally important things, but there is a vital distinction between the two. And it is really important to understand the difference. And essentially, when we look at saving, what we are doing, we are accumulating money. So any money that you have in excess of what you need, you're really putting that aside for a specific purpose. And that purpose might be to spend the money on something specific at a later stage, to keep it aside for a rainy day, or you could deploy that money towards an investment at a later stage. So there is no expectation of really growth. It's just simply accumulating the money. Investing, on the other hand, is taking that money that you have and putting that to work. So your ultimate objective with investing is to try and make the money grow. And when you have time really is your best tool, because the longer you have, the longer you can invest, and the longer you can sort of grow that money and then use compound interest to your advantage to accumulate a lot of money over time. So for me, definitely investing, you're trying to achieve a profit, you're trying to make a profit, and you want to grow your money.
So the ideal thing is obviously start off with saving and then put those savings to work and make them investments, correct?
Absolutely. So if you just leave your savings as savings and you don't really deploy it somewhere, you have the risk of ultimately the money not really keeping up with inflation. Where when you take your money and you deploy it somewhere and you want to achieve a specific objective, the objective might be just to simply match inflation. Then at least you're staying up to date with what things cost. Because I think 40 years ago a burger cost at Spur like 50 cents. Today, what is it, like $90? So if you just kept your 50 cents under the mattress over the 40 years, it would have gone to, what could you buy with your 50 cents today? So ultimately, trying to achieve an objective, and the longer time you have, the more you can grow that money, the higher return you can sort of aim for, more than inflation, essentially.
Stunning. So Michael Maré, obviously certified financial planner, member of the professional body Financial Planning Institute of Southern Africa. If you have questions on investing, do send them through on the WhatsApp line, 071 286 0639. Let's start with the big question of where do you begin with the investment journey? Because, investments is quite a broad term. You can invest in shares, you can invest in property, you can invest in, pretty much anything. So where does it begin, and how does like a person who's never invested in their lives before just take that first step?
Okay, so essentially there's 4 different asset classes anyone can invest in. And then there's different ways you can access that. And you just went through the 4 asset classes, being cash, government bonds, shares, which are equity, and property. So essentially, when you start investing, you really have to take your time. You can't rush into this. It's something that you should take your time to work through, and you want to start with a specific objective in mind. Ultimately, when you deploy your money, it needs to be there to really achieve the objective. So it starts with an objective, and once you've determined your objective, you essentially have a few choices to make. You would need to decide which investment vehicle to use. That's anything like a unit trust, a tax-free savings account, retirement annuity, and they all service different purpose. As you need to pick one that's really going to suit your needs. Then you have to decide, after you've sort of worked out, which structure you're going to use to invest into. You need to deploy that money into the different asset classes that are available, like we've just went through. And speaking broadly, where you have a short time frame, you'll need to invest in less risky assets such as cash and bonds. Where you have a longer time frame, you need to invest in more growth-oriented assets like shares and property. So then there's also the method of really spreading your investment between the different asset classes to diversify and reduce your risk. But as you can see, and as we've sort of gone through this, there are quite a few things you need to consider when you embark on this journey of investing. There's even more things that come into the picture. So for the starting point, essentially, if you can really do it, is to approach a reputable financial planner and to help them navigate you through this, because you can try and assess what you can do the research, and then financial institutions, they've made it quite easy to open up an investment account. Most of them offer an online account that you can open, but it's very difficult to really understand which ones to use to meet your objectives. And this is where a financial planner can help you.
I've got so many questions on financial planners themselves, because there are so many risks involved in asking somebody else to tell you how and where you should be spending your money, because often they kind of link to institutions or have ulterior motives. And when dealing with money, obviously, and such a complex issue like you've just explained, although you're making it sound pretty simple, I think it is quite a complex thing for people. It's kind of really difficult to know who and who you shouldn't trust. But you mentioned something on earlier that I really wanted to touch on. What was the question of compound interest? You mentioned that before, and I think I still, even though I did some accounting at school and I managed to do a bit of accounts at varsity as well, I still think the idea of compound interest needs to be explained to young people.
Yeah, absolutely. So that it's very important, and essentially, like we've just explained, time is your best asset when you invest, and when you invest with compound interest in mind, you can grow, and you have a long time frame to really grow that investment. And essentially, when we break it down, compound interest is ultimately your money making money, and then that money making more money, if that sort of makes sense. So when you invest 1,000 Rand in year one, and you earn a 10% interest rate on that, next year you're sitting with 1,100 Rand. Now you have an additional 100 Rand that you didn't have last year that's going to be earning interest into the future for you. And over time, this accumulates and it compounds, and this can create massive wealth for you if you have the long time frame. And young people, obviously, really, they have a long time frame, and if they can get started, the sooner the better, essentially.
Stunning. I really like that advice. I mean, that's why they're saying the long-term game of investments, and you put compound interest to work, because I think it'll serve you. I wanted to hop over to the WhatsApp line and just take some questions from some of you listening from home and from your cars. Hasant Richards on the WhatsApp line is asking a question. He says, what would you say is the best route to go between EFTs and, ETFs, imagine, EFTs, you put into your ETF, I suppose, and a mutual fund. I think ETFs are the big buzzword in the investment world at the moment.
Yeah, so when we look at ETFs, they are generally, what we call sort of index trackers that they often use in those sort of investments. So what you are doing, you are accessing shares via the broader market. Essentially, if you go to, if you want to buy a share, you can decide to buy it through a unit trust, a mutual sort of fund, and you can pick a manager to manage and pick the shares for you. So you can pick any sort of well-known manager out there, and they are going to select the shares in your portfolio based on research that they have done. So they would have gone to companies, interviewed the sort of, the management, the board, look at their processes in place, understand the financials, and they put a price to that share. And if they value it as if they see it's worth a lot more than what it's selling at the moment, they'll obviously buy that because they believe they can make profit from that. That's your sort of, when you go into that route, you're actually picking someone that's going to make that decision for you. When you go buy an ETF and you buy a sort of an index, you're buying the broader market. So you're buying the entire JSE, for instance. You can just buy, every share in proportion. And when markets obviously do well, you'll share in that growth, but you'll have a bunch of shares in there and you haven't selected it. And that's I wouldn't say necessarily it's a right or a wrong. But there are some sort of advantages and disadvantages to both of them.
Yeah.
ETFs are generally less expensive, so less fees going towards shipping out of your growth. But then again, when you have a concentrated market, or when we have an economy where there's a lot of sort of tech in the sector, or a lot of commodities or things like that in the sector, then you might want someone to pick out the best shares out there. And obviously in South Africa, with things that we've seen, like sort of companies not really being ethical in the way they do business, when you buy an index, you're just getting those companies in there. And when they perform poorly, you'll share in that losses as well.
Sure, Michael, this is obviously very complex but very useful information. So I hope that answers your question, Ghasant. If you have any follow-ups, please do let us know. I think a very interesting discussion with Michael Maré. He said represent CISA, and we're having a really interesting discussion about investments. And thank you so much for all the questions on WhatsApp. Seems like a really engaged conversation. So please do keep them coming through. And Michael, before I get to my questions about the discussion around financial planners, we got a message in from, I don't know this gentleman's name. He hasn't left it on his WhatsApp, but he does say, good day. Oh, I see them. My name is Vuyani. I'd like to know about compound interest in a very simple English, and how much percent can my bank help me in investments with compound interest principles? So, when they say that your investment account has got an X percentage, is that compound? And also, what are the disadvantages and advantages of investing?
Okay, so absolutely. So when we look at when an interest rate is quoted, you sort of have to look at what the bank's terms could be different. If they quote it as a simple interest rate, it's usually over a term that you keep money there, and they'd be paying you that simple interest. If you have your 1,000 rand, they'll just pay you, and if it's 10%, they'll pay you your 100 rand over the next 5 years every year. And that's essentially your simple interest. You'd have to understand the terms that they're offering with the investment that you are going into. They're not always very clear on that. That's why you have to sort of ask those questions when you approach them. Compound interest obviously is the exact opposite of where you're simply getting your 100 rand in every year. This is your 1,000. When you start with your 1,000 rand every year, it's growing by the 100 rand, and then your 100 rand is growing by another 10%. So another sort of 10 rand coming in there, and then over time that's accumulates. So compound interest will always give you more than what your simple interest would give you, and you'd absolutely have to go through the options that the bank's offering you and ask them those specific questions in terms of what is available on the offering that they are giving you. And then on to the second part, just the advantages of investing versus not investing.
Yeah, like what disadvantages could there be other than maybe your assets being tied up? But I don't think they're tied up for very long.
So, look, you can access investments in different ways. You don't necessarily always have to tie it up. Tying it up really refers to, when you invest for a long time frame, that's your best opportunity to grow your assets. And you typically need time to grow the assets. That's why we say it needs time. But you get structures that you could use that can make it accessible whenever you needed it. So that's not really what we would say. But I think the big disadvantage for for investing maybe is there's volatility that you have to work through. It's maybe emotionally it can be quite challenging for people because human nature just works against us when we invest. We have a lot of things that come into the picture when we see a loss in the strategy. It might not be permanent, but it certainly feels quite bad. But I think the advantages far outweigh the disadvantages. And essentially, I think people can't afford not to invest because if you don't grow your assets and if you don't over time accumulate enough money to eventually remove your reliance from your income, then who's going to fund your retirement later in life?
Or you'll have to just rely on the state. And obviously, given the way that things are, I mean, is that a reliance that you want to have? So it's a very interesting question. I really appreciate it, Vuyani. Thank you very much on the WhatsApp line. I hope that does answer your question. The advantages definitely outweigh the disadvantages. I can speak from personal experience as well too. The other nice thing as a young person about having investments over just having savings and savings accounts is that savings account, you're like, I could tap into it this month because I need to do something quickly. Whereas if it's an investment investment. It's more of a lust to have to go and ask the guys or to try and liquidate some of the shares and then get the money out. It's more admin, which means that you're less likely to tap into the funds that you're saving as well. Now, Michael, I did mention that I'm a bit skeptical of financial planners because, as you can tell, and as you've been expressing to me today, I mean, I'm a 29-year-old male. I've had a very privileged upbringing. I've had opportunities to understand the stuff and speak to many people about it, but I still find it incredibly confusing. So it's no wonder people do turn to financial planners for advice. However, we need to be very clear about why we're going to financial planners. And so can you give us some advice on what to do when approaching a financial planner, what to ask, what you should know?
Absolutely. So very important. I think financial planning has a very sort of bad rap because of things that happened in the past. I think it's not always been a very good regulated area, and you had a lot of sort of advisors out there just trying to sell products so they can have money in their pocket, and really not maybe suiting the needs of the person they're engaging with. These days, the regulation is much more robust, and there's a lot of emphasis placed on the client's needs and putting the client's needs first. And advisors can be held accountable if they don't actually adhere to that. But absolutely, when venturing out there, it's still you need to sort of make sure you narrow down your search for an advisor, so you can really have a good sort of quality number of advisors you can look at, and the best way to do that is really to make sure that when you approach an advisor, they are registered with the Financial Sector Conduct Authority, and you can go into their website and you can put in the name, because then they're regulated the way they should be. Secondly, you can approach the Financial Planning Institute. There's a website you can go to and you can search for a certified financial planner. And I think, a certified financial planner is someone, let me just explain what it is. In South Africa, the Financial Planning Institute is the body through which a certified financial designation can be obtained. And it is a globally recognized certification. So to be able to use the professional designation, you would have had to go through you've had to meet educational requirements, written and passed a board exam, gained experience in article position for at least 3 years, and meet ethical requirements. On top of that, you need to continually maintain these competencies and continue your education in the field of financial planning. So when you deal with someone like this, that the individual needed to go through a rigorous process to be awarded the professional designation, and they have accountability for their actions, not only through the FCSA, but also through the Financial Planning Institute. So absolutely, a good starting point is to look for a certified financial planner, because they have just gone through a much more rigorous process. Then to be specific when you approach them, ask them how their remuneration works, how do they get paid, ask them about their process, how long, what their qualifications are.
Yeah.
That's very important. Whether they're registered, and then look into that and Google them. You can Google the person and see if there's anything about them out there.
And also, just a note from a personal perspective is if they're completely coming at you with their Ferraris and flashy and telling you that they make millions for people and that's their lifestyle, and you would be an idiot not to sign up with them, etc. It's red flags. Stand far away from people like that. Thanks so much for the questions on WhatsApp. I got another one in here. There we go. It's in from a number that ends in 0731. It says, hey, I'd like to know what's your advice on going to the bank for financial advice and investing as opposed to a private individual. And it's Roland, he says, by the way.
Okay, 100%. So I think, when you look for an advisor, you probably want to look for someone that we would call independent. So it just gives, it means that they can recommend something that would suit you without the motivation of selling the product at the company they work for. So they can access a much bigger sort of pool of options out there. And perhaps when you approach a bank, they might only be offering whatever their service offering is. So they might only sell their products. An independent person, a private individual that's not tied to a specific provider would give you they would give you more options and you'd know that they're not incentivized to sell a product that's only available to them through their affiliation.
That's very wise advice. Obviously, one of the scariest things, you get a lot of these institutions who say that I'm a certified financial planner for this institution, and you say, like, how could you really be true and effective if you only give me one side of the story? Vuyani asked me something on WhatsApp that I think is linked to something that I'm personally interested in, which is about investment scams. And everyone throws the word Bitcoin and scam in the same sentence, and I don't think they necessarily are. Bitcoin is just another vehicle that is quite a risky vehicle. And he says, is there a company or bank that allows you to invest in Bitcoin? But I think it's linked to a broader question, is how do we avoid scams and know where safe investments exist, or are there such things?
Yeah, so absolutely. So I think, obviously in a time like this, when things are quite uncertain, and if you look at the investment returns, things have been quite volatile and perhaps not as good as people have had it in the past. So investment scams in a time like this really tends to pop up more frequently because they take advantage of situations like these, and they prey on vulnerable people. So there are ways in which you can spot an investment scam. So I think you mentioned a very good one. Someone coming to you with a flashy car showing, this is what I have, you can have it too. Absolutely, that's a bad sign. But also there's the old age saying of, if it seems too good to be true, it usually is. So that's definitely something to look out for. If you are being rushed into making a decision, that's a bad sign. Any proposition you need that needs you to find additional investors, that's a telltale sign of sort of a Ponzi scheme. And risk and return is always linked. So if you want to achieve more growth, you should be taking on more risk. So if there's a guaranteed return of a certain amount without any risk, it certainly is a bad sign. Return in excess of what's reasonable. You can only, that's obviously quite bad. And then you can avoid these things by just sort of making sure you Google the person, Google the company, ask around, only deal with registered and reputable financial planners and companies, and ask questions and assess the answers. Does the person know what they're actually talking about? Can they explain the investment that they're offering and how it actually works? So when you do these things, hopefully you should be able to avoid most of them, or at least all of them. And then, I think Bitcoin, you have to buy Bitcoin on an exchange. That's typically how you do it. I think it's Luna in South Africa. But you need to understand obviously what you're investing in and
research before you take any of those big decisions. I think it's an important question because you did raise it earlier on about finding financial planners who are listed, and you mentioned the FPI. Could you just give people the website address for finding reputable financial planners?
So you should be able to find them on www.fpi.co.za.
Stunning. That's absolutely amazing. And I really, really do appreciate all your questions on WhatsApp. I'm sorry we didn't manage to get through all of them, but I did get a message that I think wraps up the conversation quite nicely. Antone Dolly sent a message to say, wow, some really good financial advice there. So Michael Maré, thank you so much for all of your wisdom and advice today on investing. I think the things that I've taken away from your conversation, obviously start from a very early age. This helps you allow investing and your investments time to grow. Compound interest, obviously, aids in all of that. Obviously, various asset classes to invest in, like shares, bonds, property. I've learned more about the differences between those. Financial planners can help you kind of put a portfolio together. Just choose reputable ones and take your time when investing, and don't make rushed decisions. Don't let somebody rush you into doing those investments for the first time, and then just seek the right kind of advice. I think that's what I've taken from